Welcome back to another episode of Singapore's Real Estate Explained, brought to you by the JNA Investments team. And today we're going to be talking about
how to invest in your first property at Investment 101, back to the basics. Okay,
Yeah.
because we realize that people are asking us, how is it possible to invest in your first property and what are the know-hows? So that's something we'll share today, and we hope that you will get more insights through this.
So we've done a lot of new launch reviews, but we also do have clients that come to us and say, I'm just starting out in the market. What are some things that I need to take note of? And they're not that well versed. That's why we decided to come up with this video where we basically let you know everything that you need to know, from what's your loan eligibility, how much you need for your down payment, let's say you're looking from own stay versus investments, how do you identify the projects? And also from a cash flow perspective, how should you focus on capital appreciation or should you focus on rental yield?
Yeah, most importantly, some of the misconceptions when it comes to people think I can make quite a lot of money from renting out.
Yeah.
Like, how are the actual returns looking at if you do a rental property investment?
Yeah, so that's something that we'll cover. So let's get started.
So before we start, I'd like to thank all our clients support us thus far. We've grown about 17.2k subscribers up to date, and good review. Thank you for leaving your 5-star reviews. 209. It's always very exciting to see this number growing, which shows that we are doing something right. And up to date, we are thankful to serve over 713 clients, in fact close to 800 with 19.56% annualized returns. So you are looking to start your first investment property purchase or just wondering how to restructure your portfolio, you can scan the QR code right below and we'll get our investment strategies to reach out to you. Alright, so without much further ado, let's start today's topic. First thing first, okay, before I talk about investment, it's to be clear that you're looking at investment or own stay.
And this is a question that we always ask our clients, right? Like when they come in and they say, I'm looking for my first property, or they say, I've got like HDB that actually MOP already and I want to restructure and I'm looking to do my next purchase. We always ask them, what is your priority? Is it for investment or is it for own stay? Because the things that you would have to consider is very different also.
Yes. So if it makes our own stay investment, in the end, we notice that clients will end up making the wrong choice in a sense that they expect to make money from real estate, but in the end they don't. They will end up being very confused. So it's always to be very certain that if you enter your own stay, the priorities are different. Investment, the priorities are extremely different. The matrix looking at are also very different.
Yeah, so I think looking at some of the differences, when you talk about your primary goal, I think in Singapore, I would say 80% of the people, when they look at their next property, it's usually more from an own stay perspective. Anything that fits their lifestyle, you have to consider things like your location, whether you want to be closer to your parents, whether you need schools, more for comfort. But from investment perspective, it will be more on whether the numbers make sense or not. Even if the location is not something that you are looking to stay in, it's fine, right? Because you're just purely looking at exiting in the next, let's say, 4 to 5 years.
Yep.
Priorities are also very different. Own stay, you're looking at your layouts, your facing. Example, if you don't wanna face a car park. But what if that car park facing one make you 500k? Are you okay to stay inside or not? So these are the things that you have to consider. But for investment side, you have to consider what's your entry price, what's your exit strategy. If you're looking at a passive income, then you have to look at your rentability also.
Yeah, in terms of time horizon, once they own stay have a bit of life circumstances involved. Is it near the school that you want? Is it something that you plan for your kids? So it's really something that you need to have more thought put into it. For investment, it's always about exit. Looking at the horizon, usually now the fastest 4 years or 5 years exit, how you plan to exit this property to cash out so that you can reinvest in next property or potentially use it as your next own stay home. And last one is a cost. Okay, if you own stay, take note, usually the emotion factor will kick in and this actually affect your returns. Because a renovation cost, which sometimes can take out to 100k, 150k.
Usually you want to renovate according to your own
taste, which may not be someone else's taste. So there's something that in investment, once it makes it up, you end up not really getting returns you want after factoring all this costs.
We always say from an investment point of view, renovation is a sunken cost in a way that yes, the next buyer may like your renovation, but if they don't, then it's something that they are not willing to pay for.
Yep.
Yeah.
Okay. And only saving grace over here you have as own stay is owner-occupied property tax.
Yes.
So it's actually lower than your non-owner-occupied property tax for investment. You rent it out. And there's also rental income tax you take into account, rental agent fee that you need to factor in if you are doing a resale for rental.
Yes.
But think for new launches, you don't have any property tax, rental income tax, or your rental agent fee. So it really depends on what kind of property you're buying into for investments.
Yeah. So I think clients always ask us, they say, can I find something where I like it for own stay, but still make money. Like I don't want to lose money, right? And I would always reply that I say possible, right? It's not completely impossible that you find some place you like and then you still make money. But I think there has to always be a point where you need to know what's your priority. Like if it's like 49-51%, which one is more important to you, so that you know that when you select your unit, is it more on like the numbers or whether it makes sense from a pricing point of view, or would you sacrifice like a little bit of profit so that you can find something that your family really likes?
Yep.
If not, most of the case when people are not clear, what happens is that they find a unit, they don't exactly like it completely from an own stay perspective, and it's not the best investment unit, then it becomes a very half-half. Means like both ends, they don't get it also.
And that is when the complication comes in. For investment, where there will be times where you buy into a place that's not a good location, far out, but it's based on value-wise, it's really undervalued in terms of the pricing. And meanwhile, you buy in some place with own stay, you naturally factor in all this emotion factor next to MRT location, which help to bump up the price and end up you buying overvalued rather than undervalued. So there's some things that if you once you mix it up, we notice the returns of the investment will all be affected.
Yeah, so I think just to put it in perspective of some examples, right, we can look at let's say a location that is not as ideal from a own stay perspective back then versus like a location that would have been ideal for our own stay. We look at Riverfront versus Sengkang Grand, right? If you're talking about own stay, people may want to stay somewhere that is integrated near the MRT, near to amenities. But of course, when you're talking about buying somewhere closer to amenities, it also means that there is always a premium to the pricing. So we'll look at let's say 2019 period. If you were to have a 1.4 million budget, because of the premium in being near the MRT at Sengkang Grand, you would be able to enter in a 4-bedder of about 764 square feet. As compared if you were to go to Riverfront, where location-wise not as ideal, there is no MRT, is not walking distance, amenities-wise is not as ideal, but because of the cheap entry price, with the 1.4 million plus budget, you would be able to enter into a 3-bedder. And when it comes to exit, let's say in 2024 period, you will see that for Sengkang Grand, someone can collect keys, and if they decide to offload, it's not like your own stay or more ideal location doesn't make. So they still did make about 100 to about 200,000. But you would see that Riverfront, with that same equity in as an investment, they actually exited close to about 6 to even 700K of profit. So that difference is almost like 3 times.
Yes, and that makes is almost equivalent to someone's close to 10-year income, or in fact, like close to 20 years of savings. So it actually makes a lot of difference when it comes to identifying investment property versus own stay property.
Yes, because people may say that, whatever you buy during COVID, everywhere made money. But the difference in each development that made money, even though they may be in the same area, it could be like a 2 or 3 times kind of difference.
Yes, indeed.
Another example that we would see is Normanton Park versus One North Eden, both in District 5. But of course, Normanton Park at that time was a development where people say, there's basically nothing. There is no MRT, there's 0 schools. It's in the middle of the highway, there is no amenities. As compared to One North Eden, where it's next to Buona Vista MRT, that's also where you have like Star Vista, which is your mall, and you have all your amenities in. Again, with that same purchase price of about 1.5 to 1.6, at Normanton Park, you could buy into a 3-bedder because of the lower per square feet. At One North Eden, you would buy into a 2-bedder, which is about 786 square feet. So when it comes to exit, let's say 2024, right, you would see that One North Eden, it's not that they didn't make, so they still made about 200 plus K. But Normanton Park, you will see that the difference is about 500 plus K.
Yeah, and that's actually 2.5 times more.
Yeah.
Okay, so once you have the emotional element coming in for like MRT, which is very something close to Singaporean heart. They love to stay in places that is very convenient, and that is when the returns can almost be half just because of this element.
Yeah, so I think we have a lot of clients that come to us and they're very like curious on like how come developments like Normanton Park, like Riverfront, to them they cannot imagine themselves staying because there's like to them it's like there's no MRT. The convenience is not there. Why would someone want to buy it as their own stay? Or why are these developments able to make a profit above 500 plus K? I don't think we'll go into details today on how to identify differences like a development that made 100 plus versus a development that made 500 plus. But if you're keen to understand what are the factors that differentiate these developments, you can always scan a QR code and we'll be happy to explain them to you also.
So first, let's talk about the cost involved for own stay or investment. Okay, one of the first costs we'll look at is this called a property tax. Okay, so property tax is based on this thing called annual value, which is actually the
secret number.
secret number
Nobody know.
Yeah, by the SLA to determine the value of property, and it's actually quite tied to the rental market.
Yeah.
Okay, it's usually a rough gauge of a rental property multiplied by 12 times 10 times 0.6, 0.7. That's a rough calculation.
They normally say it's like the annual rental that you
Yes.
would get in for that unit, but usually it's like what Chris mentioned, you take a 0.6 rather than the full market rental.
Yes, correct. And using the annual value to determine how much property tax you'll be paying. And to make it easier, let's take a look at one of the example to determine what is the property tax over here. If it's own stay, okay, property under owner occupier tax rate, you can see the tax over here is $1,002 for an annual value of $45,000. Okay, meanwhile for a rental property,
Yep.
okay, you rent it out and collect rental. Okay, on top of all the other taxes you see in a while, the property tax will actually close to 5 times more, about 6,600.
Yeah, so it's quite significant when you're looking at like owner occupied versus like non-owner occupied.
Yes, the only key thing to highlight here is if it's a new launch, of course, then there is no property tax at all.
Until you collect your keys.
Yes, correct.
Okay, so after you define whether you're looking at own stay or investment, I think own stay wise is a little bit more straightforward because profits is not your priority. So it's really looking at just getting something safe. You're not overpaying, but the main priority would be in the area that you want. What is the, let's say, layout, for example, the different facing, etc. But let's say you decide that, okay, for now, my focus or priority is on investment, then you have to then decide the next question is, what is your investment strategy? Is it going to be like capital appreciation or is it going to be building a passive income?
Yeah. So once you go invest strategy, there are two ways you can make money from real estate. One is capital appreciation. The other is passive income, meaning from rental. So for capital appreciation, you can see the goal is about making as much growth in terms of property appreciation within the shortest period of time.
Yep.
And meanwhile for rental, passive income is usually generating consistent yield every single month. Yeah. Meanwhile, for the risk of capital appreciation is usually for capital appreciation property is usually a place that you stay or potential a new launch. Okay, so there is actually no low rental support. The rental yield may not be the highest.
Because the focus is not on getting the high rental yield.
Correct. And meanwhile, if you look at passive income, usually using it more towards a retirement planning when there's more pocket money is very important to them. Okay, but there's still a risk. Okay, where there can be a chance where there's no tenant. Okay, so the vacancy risk and a lot of this kind of high rental property tend to be, I would say, slightly older or really not as desirable in terms of some of the own stay condition.
And maybe people want to buy like very old properties that they bet on the en bloc, for example.
Correct.
But if let's say it doesn't en bloc, usually these properties may not have the best appreciation.
Yes, because of age. And one risk for en bloc to take note is that sometimes, there's en bloc hype. So the price actually goes up during the people buy into either they were en bloc.
Yeah.
But when en bloc fails, there's a chance that the price can crash by 10 to 15% overnight and people just decided to offload it because they can't en bloc the price they wanted. So there's some of the risks that you have to take note for this kind of older properties. Okay. Last one list is the property types for these two given type. Capital appreciation is mainly for new launches or resale, but passive income we only can get it from the resale properties.
Yeah, so I think whether it's capital appreciation or passive income, it really depends on your stage in life, like which stage are you at and what's your focus. And I think for Chris' side, you had experience with both, where for your parents, you built them a passive income in real estate, and for you and Zing, which is Chris's wife, you guys went into a new development for the capital appreciation. So what were some of your considerations back then on deciding which one you should go for?
So one thing is, of course, age. Okay, so when I realized for my parents when they are hitting 60s, 50s, the key thing is not about wanting to grow their wealth or capital appreciation. It's towards like, how can they retire using passive income without needing to work? So that is when you go to higher yield assets that are more defensive. You don't need to sell them. The key thing is just calculate the pocket money per month and making sure that...
So how much pocket money do you build for them?
Okay, just both of them is about close to 5K pocket money and potential raise up to about 12K just in the next 5 to 10 years. So that's something that you plan out a safety net for them, a nest that is able to generate passive income. But when you look at our own portfolio for capital appreciation, once we settled my parents' side, we realized that actually we're still young, there's still a long runway, 30 years of working, and we do not need the immediate rental income to supplement our daily lifestyle. And we see our income coming. So our key aim is looking at high growth properties that, but in some cases, the new launch selling cheaper than resale, like in terms of the price tag, okay, around the surrounding, and entering it so that we'll be able to catch this kind of market wave for capital appreciation in the next 3 to 4 years' time.
Yeah. So I think whether you are looking at capital appreciation or passive income, it depends on your circumstance, right? Are you still able to get a loan? Are you able to leverage on things? So if you're in a situation where you're unsure and you just want some clarifications on which one should you focus on, you can also reach out to us and we can break down the numbers to see for your portfolio which one will suit you a little bit more.
Yes, indeed. All right. So next, let's take a look at the rental income calculation. This is very important because a lot of people always has this idea that
they want to be landlords.
Landlords. I buy a property, I rent a high rental yield.
The tenants are paying for my property.
It's an assured gains that's coming in.
So looking at the breakdown of rental income calculation, exactly what you will earn from it and what is your outflow. If you're looking at a 1.5 to 5 million, I'll show you an example. Let's say we bought this in 2020. Last few years, interest rates have been hovering around the 1 plus to about even, I think highest was
4.2%.
4%, right? So average I'll use a 2%. Your monthly payment would have been 4,227. So that's your total mortgage, right? Of course, you have your interest and principal, which we'll talk about it later. You pay property tax, which is about 264. This is non-owner occupier, meaning you rent it out. Then you have your MCST, assuming it's 270. Income tax that you pay on it, that is about 264. A lot of people miss this out until they get hit with the when you have to report their taxes, then they realize, actually I have to pay income tax on my rental. Then you have to pay your agent fee for the rental, let's say 175. Your total outflow in here, it's a 5,002. So with a rental of, let's say 4,002, which is about 3.3% rental yield, which is, I would say not too bad, like the average, right? You still would have an outflow of $1,000. Can be paid by CPF or cash.
Yeah, so take note to even not have outflow, usually you have close to a 4 to 4.3% kind of rental yield to not get this. Yeah, but one thing people will say, now it means every month I'm bleeding money, but it's not true because in terms of your mortgage, it's always split into two parts. There's basically interest and principal, where interest is actually burn, means you can't get back anymore. Through the sea, yeah. Then principal is actually used to pay down your mortgage.
Yeah.
So the actual cost is actually not the total mortgage, okay? It's actually only on the interest portion. So the actual cost you're incurring is about $2,879 dollars per month. And with a rental of $4,002, actually every month you're actually getting about $1,321, okay, paying down your mortgage every single month. Just that every month of the $1,000 of outflow, you need to always be topping up. Yeah, so this is some parts you need to take note when it comes to calculating the actual returns.
Correct. So in short, every time people say, hey, I receive 4,002 that is going to help me pay my mortgage. Actually, that 4,002, it's not full equity into your property because every month you're incurring $2,879 of costing. So you have to factor off all these costs for rental side, and then your actual rental income that you get, it's about $1,321 a month.
Yeah. So you sum this up together, $1,321. Okay, you multiply by 4 years times 12 months, you will get about $63,000.
Yeah.
Yeah. So this $63,000 thing is whatever you earn just on rental for the 4 years. And this is something that we notice. If you look at the costs, there are other costs involved in how you buy a property. There's buyer stamp duty, there's agent sale fee, okay, and legal fee. Add this together. And with this $1,321 being paid out every single month, okay, paid off the mortgage, okay, over 4 years, you'll get about close to $63,000 of equity, okay, which you use actually to pay down the mortgage, okay, and this can only be unlocked when you sell the property.
Yeah.
Okay. One thing to take note is that in terms of cost, okay, the cost-wise over here, you have buyer stamp duty, agent sale fee, and legal fee. Add together is $84,000. So in short, if you were to take just pure rental,
okay, assuming this property doesn't
appreciate all, 63,000 minus 84,000. If you purely rely on rental to really earn from property, you're actually losing $21,437. And this is something that people don't know, that they always say, I prefer resale because I can rent out, I can get immediate income.
Yeah.
But the thing that people may not know is, by looking at it, actually you're still losing money. That is renting out and not looking at capital appreciation at all.
Yeah, so we're not saying that resale doesn't go up. Of course, if you're resale, we've seen resale actually made quite a bit over the last few years, right?
Yes.
I think the focus is just that when you're looking at a property, don't give up or don't sacrifice on capital appreciation just because a property has higher rental yield, but focus more on the capital appreciation side of things. And if there is high rental yield for that property, it's always a bonus.
Yes, indeed.
So for the 1.525 million that we shown the example previously, it was actually from a unit of a two-bedder unit that was bought in 2020 that's a resale, so that you can immediately rent it out for rental income. With that same budget, you could enter into a new development in OCR, not near the MRT, but a 4-bedroom. So if you're talking about capital appreciation, you would see that the 4-bedder in the end exited 2024 with a capital appreciation about 609,000 as compared to, but of course then there is no rental income because during the phase of construction, you're not able to rent it out. And then for the 1.525 resale unit that you would have been able to rent it out, eventually they still did profit. So in this case, they actually profit about $105,000 with the rental that they got for 48 months of 63,000. The total profit that they got is about 168,000. So again, you can see with different investment strategy, the returns that you're getting back is also very different.
Yes, you can see in this case, the capital appreciation outperformed that of the rental yield and capital appreciation. But the key thing over here is that if you just focus on rental and you don't focus on what is the capital gain, at the end of the day, you will realize that the returns you can get back at the end of the day, just purely rely on rental itself, it's not enough as compared to one that fully focuses on capital appreciation. So,
because of the quantum and the cost in Singapore.
Yes. So in this case, you can see that the rental yield and capital appreciation add together for the second case is actually almost 1/4 that of the first case. So if people just focus on rental, the downside is that in the end, the rental itself won't give you the returns. The one that truly give you the highest returns is capital gain, as you see in this case.
Yeah, so I think in Singapore, if you are young, you can still take a loan. That couple hundreds of dollars or $1,000 doesn't really affect your monthly cash flow. They will say focus more on capital appreciation as compared to the rental yield first. Unless you are like retiring and you can't really leverage on your loan and you're looking to restructure to build an income to replace your active income, then maybe that's when you may want to look at passive income growth.
So I combine these two strategies together is when young, build your equity, build your capital, such that when it comes to retirement planning, you can buy into a bigger property, give you a higher passive income. So it's always a built up rather than one that's, now I'm young, I just want to get pocket money. It's not very wise to do that as compared to accumulating more and then subsequently retire with more passive income.
Okay, so the next thing I want to look at is monthly cash flow. So we've talked a bit about, what the profits look like from a rental versus capital appreciation. But what would the monthly cash flow look like if you were to look at the resale property versus a new launch property?
All right. So for resale property, as you've seen just now, let's turn up a notch today. Okay, 2 million property. Okay, at now it's a 1.55% interest rate. Okay, mortgage is a 5.2. Private tax 350, MCSC 350, income tax 444, agent fee about 241. Okay, but then you get something in the market with an outflow of 6,597. Okay, rental right now, this is an exact property we see in the market, 5,008. The outflow a month is 797. Okay, of course, this outflow can either use a CPF or cash to pay.
Yes. So let's look at how the new launch cash flow would work for a similar $2 million property, assuming, let's say, for a couple, every month their CPF OA comes in is about 2,990 combined. So at the start, you wouldn't have to pay any mortgage because on new developments, your mortgage only starts upon foundation, which is usually 6 months in. So there is zero mortgage at the start, which is in the pink column, but you would still accumulate your CPF along the way. Once foundation is start, that's when 100K is being dispersed from the bank. That's when you pay the mortgage on 100K and that's $318. But you still have surplus about 2,000 plus that will accumulate. So it continues to increase 900 plus, 1,002, 1,005 and 1,009. And you would see that there is no cash top up at this point because most of it would have been covered by your CPF. So let's move forward to maybe about the 24 month in, which is 2 years. You will still see that, that's when my mortgage jumps to about 2,223. But because every month your CPF is about 2,009, right? So at this point, you still would have a surplus that will continue to build in your OA all the way until when you hit your TOP. So upon TOP, that's when you hit 3,008, but that's also the point where you can actually rent it out. And likely the rental would have, the full rental would then become like a positive cash flow because at this point now, you still haven't touched any of your cash. In fact, you've built up like your OA all the way up to maybe about 60K at this point, and the shortfall of 821 would be covered by the OA.
Yes, so in short, if you were to as we're working, it has CPI coming every month, that CPI can be used as a safety buffer.
Yes.
And potentially you may not be coming out of any cash for the next 3 years to 4 years because of the progressive payment scheme.
And because of new launch, you also have no property tax, you have no MCST, you don't pay like agent rental fee, etc. So the cost of holding it's much lower because your interest is increased progressively.
Yep, correct.
So you would see that in both cases of resale and new launch, when you do rent out the resale, there is also no cash outflow. The outflow can actually be covered by CPF, but that's on the assumption that you do get a tenant. For resale, the risk on cash flow is a bit higher because in the event, let's say your tenant run away, which we've seen before, you have to get the police in to try to get back the unit. But when that happens, you must be ready to be able to tank the 6,000 plus. As compared to a new development, you're quite certain on like the amount that would be fully covered by the CPF.
Yes.
As compared to like the 6,000 plus.
Yes, indeed. Right. So with this, to assess whether it's new launch or resale, it's not really about the progressive and non-progressive, but it's about whether there's capital appreciation potential for the unit.
Yep.
But that will be assessed on a separate basis. But with that, let's move on to the next part about what are the stamp duties you're subjected to whenever you buy a property. Okay, back to basics. Okay, total got 3. Okay, one is called buyer stamp duty. It's paid by almost
Everybody
everyone.
must pay one.
To
So
pay
people
this.
say, if I'm not buying a second property, can I don't pay buyer stamp duty? Cannot.
Yes, everyone in first or second property, even
HDB
foreigners,
also.
Singaporean, all have
Yes.
to pay. Then there's this other additional buyer stamp duty is based on what kind of nationality you are, Singaporean, permanent resident or foreigner. The last is sales stamp duty. We'll cover if you were to sell a property within a certain number of years, then yes, you have to pay for this tax.
Yeah.
So first, let's talk about buyer stamp duty. So buyer stamp duty is actually based on the purchase price you're buying. It's progressive. The higher you pay for the property, the higher the buyer stamp
So they
duty.
basically tax the rich lah. The more expensive your property, it's not
You're
it's not
buying,
a
yes.
fixed rate. Yeah.
So if, for example, you have $1.5 million, okay, for a property, the buyer stamp duty is about 44,600. If it's 2 million, it's about 69,600. If it's 2.5 million, it's about 94,600. Calculation-wise, you can count it separately, but just take note, it's actually progressive.
Yes. And then for ABSD, if you're a Singaporean, your first property, it's there is no tax, so you only pay the buyer stamp duty. There's 0% of ABSD. But if you do decide to buy your second property, it's going to be 20%. Last time was 17%, but they increased it after 2023. And if you buy your third property, it's going to be 30%.
So for PR, okay, for our first property, it's actually 5%. Okay, second property is 30%. Third property onwards is 35%. And meanwhile, for foreigners, okay, the recent news, you went from 30% to 60% for any kind of property you're buying, regardless it's first, second, or third. Last one is entities, company. Last time people like to sell a company to buy property. Now they have a ruling that if you buy a property under an entity, is 65%. The only exception over here is for developer. Developer, if they buy a property to build, okay, what they have to do is it's called ABS remission. Okay, total ABS is 40%. But take note, at the start, they just have to pay 5%, okay, to buy a land and to redevelop. And if they already sell all the units, okay, within the 5-year mark,
They can get it back.
then they can get the 35% back. But take note, the 35% you don't have to pay upfront. You only have to pay if you do not manage to sell the property within the 5-year period. Okay. Last but not least, we have trust deed. Okay, very popular back then. Where parents buy a property under the children under trust deed, full cash. Okay, now the ABSC is 65%. But take note, you can actually claim it back if there is no special condition.
But the fact that you must come out with 65% first of the property.
It's always tough. All right.
Yeah. Okay, next one we looked at is seller stamp duty. Last time why there was seller stamp duty is basically to stop people from flipping the properties. Like you buy and then, I don't know, like 1 week later you decide to flip it. So there's a lot of speculations in the market. That's when it's okay, minimally last time you need to hold for 3 years, but now SSD it's 4 years, meaning you have to hold a property for 4 years to avoid paying any seller stamp duty. And if you do sell it before, if you had it for 3 years, you have to pay 4%, 2 years, 8%, and 1 year, 12%. Meaning, let's say you buy today, next year you decide to sell. When you sell it, you have to pay 12% of that property price, that the sale purchase price.
Yes, all right. Next, let's take a look at the budget and loan.
So when you look at loan eligibility, there'll be 3 matrix that you have to look at. TDSR, which is your total debt servicing ratio, NSR, which is your mortgage servicing ratio, and last but not least is loan to value. So what each of these exactly mean? Total debt servicing ratio currently is at 55%. It means that 55% of your income That's the max you can use to pay off any debt that you have. This can include like your car loans, your personal loans, etc. And this is used for private properties. For HDBs as well as EC, they use a separate matrix called the mortgage servicing ratio. And this basically means that 30% of your total income can be used to pay for mortgage. So they don't consider any of your personal loans, any of your car loans. And last but not least is your loan to value. So this is the maximum percentage property value that the bank can lend you. So most of the time, the maximum is 75%, meaning if your property is, let's say, 1 million, for example, the max the bank would lend you is 750,000. Even if your TDSR or MSR is able to loan you more than that, but it's actually capped at your LTV.
So first, let's take a look at total debt servicing ratio. To illustrate, let's use these two examples. Okay, if you have buy A and buy B, same age, income, both the same 6,500. Okay, no other loan. Okay, if you buy a private property, the maximum you can borrow is about 1.462 million.
Yep.
Okay, so the younger you are, the longer the loan tenure you have, and the more loan you can borrow. Okay, but if you were buying into executive condo, okay, or HDB, you're using this metric of MSR, mortgage servicing ratio. That's why you see for the same income and same age and same profile, the amount loan you can borrow is
Greatly
almost
affected.
half. Yeah, half of that of a condo. That's why the max loan you can borrow here is close to 800k only.
Yes.
The only good thing for EC over normal HDB is the max loan tenure is 30 years. Meanwhile, for HDB is 25 years, which means HDB, the maximum loan you can borrow is even lower at $723,000.
Okay, so if let's say with that same profile, now I have a $1,000 car loan, you will notice that it doesn't really affect my MSR. My MSR or the loan for EC and HDB is going to be the same because the 30% of MSR only takes into account mortgage loan. But you'll see that this 1,000 car loan would affect my TDSR. And for my private properties, without the car loan, you can loan up to 1.462 million. But with this $1,000 car loan, your max loan goes down to about 1.257. So that's almost a 200k difference in loan with that $1,000 car loan every month. So every time when a client comes in, right, and they have this car loan, right, it actually affects the loan that they can take quite significantly.
Yes, it's almost go to 10% of the loan reduction for $1,000. Yeah, so it's something that there are different ways to go around this. That's something that we'll run through some of the ways to creatively finance this kind of a purchase. All right. So the first way, the very simple way, is this thing called pledging versus unpledging.
So pledging and unpledging basically is for people that, you have not enough income or you don't have income, but you still want to take the loan. And to give an example of like someone that has insufficient income but wants to go for a higher loan eligibility, let's take a couple that, it's age 30, both earning 5,000. Their loan eligibility from the bank would be 1.124. So this is the loan amount that they're qualified for. But if let's say they want to go for a 2.4 million property and they want to max out the LTV of 75% and they want to get a $1.8 million loan, their shortfall, it's about 675,000 because the bank only allows them to loan up to 1.1 based on their income. So the straightforward way of this 675, right, is like sometimes Parents Help, they may just down pay this 675,000. So the shortfall of 675,000, the most straightforward way what some people do is like I directly down pay. Sometimes it could be from Parents Help or they have a lot of cash being saved up. But that also means that a lot of equity is going to be locked inside this property itself. So other ways that they can do it, out of this 675,000, I can say, okay, let me take $289,000 out and then lock in the bank for 4 years. Anyway, if I were to pay down, I would also be locked in that property. So rather than lock 675, now I'm locking 289k. Then the bank would lend them this shortfall of 675,000. Alternatively, you need a much bigger amount if you just want to show funds. Then you need 961,000. In the unpledged and show funds method, the bank doesn't require you to lock in. So you just have to show them that you have this amount in their bank once at the start when you apply for the loan, the second time when the loan is being dispersed. This also means that when you down pay for your property, right, that cash cannot come from this 961.
Yes. And of course, there's some other way where pledging, for example, you want to don't pledge for 4 years. You can, once you pledge to the first bank for 2 years, when you refinance to another bank, you can actually take out the pledge amount you put in the bank. And that's after locking period for the bank loan. And that allow you to actually not lock in the property for too much, but take note your next loan that you borrow. Yes, you can stretch your TDSR actually using certain creative method. But the key thing over here is you must make sure TDSR can able to fulfill for the next loan that you're borrowing.
Yeah, so it's not a all thing. It's not either pledge or unpledged. You can also do a and, means you can see how to kind of structure such that you can pledge a lower amount but also unpledge some cash. But if you don't want, you're lazy to calculate, just reach out to us. We'll just do the full calculation for you to see how to optimize your loan also.
Next, okay, investment basic 101 is timeline planning. Okay, so how will time vary between a new launch and resale? Okay, so for new launch, take note it is a 8 weeks period from start to the end. If you buy a new launch, okay, the first thing you have to do is to pay a 5% deposit. Okay, for example, a 2.4 million property, this will be $120,000. Okay, and within 2 weeks, okay, you will receive this thing called a sales and purchase agreement, and this will be delivered to your law firm. Okay, your law firm, and within 3 weeks of receiving, you need to exercise your SMP. Exercise means you sign.
And if you don't?
You don't, then you'll be forfeiting
not the 5%.
Not the 5%. 25% of 5%, which is effectively about 1.25%, but 75% of this 120k refunded back to you.
Yes.
So about 90k. So you lose about 30k in this case. Okay. So if you exercise and okay to go through, the king over here, within 2 weeks, you need to pay this called the stamp duty, the buy stamp duty, which in this case about 89k, 600. Okay. And the last amount, completion, the last 15%, okay, is due 8 weeks from the OTP date. So that's $360,000.
Yes.
Then the last portion what we do is when, depending on projects, the project, if the foundation work is due later, it could be 4 months or 6 months later, the remaining 5% will only be due in that time frame.
Yeah, so that will make up your total of 25%. 5%
for the down payment.
At the OTP, 15% upon completion is 20%, and then the last 5% is upon foundation.
Yes, but of course the foundation work is for post-launch where the foundation already caught. This 5% will be lumped together 15%. Yeah, to be due within 8 weeks period.
Yeah.
Of course, there's other timeline like COH extension, which you can stretch the timeline, but with that they can cover in another session.
Yes. So for how, how does that differ from a resale transaction? For a resale, when you see something that you like, instead of a 5%, you pay 1%.
Yep.
So let's say you decide not to exercise it, right? You'll lose out this 1% as compared to a new launch where you decide not to exercise is 1.25%. But normally once you commit, make sure that it's something that you want. So that, it's quite a significant amount in a private property. Then when you exercise for resale, that's when you confirm you want this property. That's when you pay 4%. So that's 96,000. And then within 2 weeks, you have to pay the stamp duty. So one thing to note is that for new launch, your buyer stamp duty can be directly deducted from your CPF payments. But for resale, you have to pay cash upfront first, but you can get a reimbursement from CPF afterwards.
Yes.
Okay. And then for the completion, usually it takes 12 weeks. For new launch, it's usually 8 weeks. But for resale, it's really up to how you negotiate with the seller. Sometimes it can be shorter. Sometimes it can also, I've seen cases where it stretches like a year or like 9 months.
Yes.
So this really depends, right? But normal completion is 12 weeks. And at the end of 12 weeks, that's when you pay the 20%.
Yep. So it's only on completion date, like what is complete foundation for new launch. That is when you disperse your loan, and that's when the loan starts. Usually about 1 or 2 weeks after 1 month after your sales completion.
Yeah. So I think we've covered quite a bit from the timeline side to, your cash flow, your down payments, the intention in buying. And the next thing then comes down to, okay, now that I've kind of understood the whole process, how do I select a unit?
Yes. So for unit selection, okay, if you're looking at a resale unit on platform, there are 2 platforms that is usually quite well used.
Most of the units will be there.
One is probably Guru, the other is Naya.co. Okay, and you can just key in based on your selection. Do you want a 3-bedder, a 4-bedder, or what's the price range, and then from there you can limit your search.
Okay, so for new developments, there is no exhaustive list of property because everybody just posts, right? So there could be duplicates. Usually, how do you see a new development coming up? You can actually scan and we can send you a guide. If not, usually you can also look out on our YouTube channel where we actually post these reviews of like the upcoming new developments.
Yes. So if you're in the market looking for a resale or new launch, these are some of the factors you have to consider. So first up is the price gap compared to selling resale to understand what is the value you're buying into. If the gap is very wide, okay, where you are way expensive than selling resale, do be careful because you may be overpaying. But meanwhile, if you can buy something that is below the market value, then of course is something that is worth considering.
Yep.
Okay. Second is understand what is the supply pipeline in the next few years for the new launches or those TOP projects coming up, because this kind of new pipelines will actually set the benchmark of the prices in the area. So if you're buying something there's upcoming land bids that will be setting a new price tag, you can actually use that as a price hedging to sell your unit later on.
Yeah. Or if a or if a development that you're buying into, right, when your SSD is up, you're expecting like influx of developments that are going to hit their TOP, then that's something that you want to be a bit more careful about because it really depends on your unit type. If you're buying to a smaller unit type, for example, let's say a 2 beta, then you know that you're going to have a lot of competition. Your pricing have to be very competitive when you enter.
Yes, but of course, along with supply, you also trace the demand in the area, not just looking at supply, so many units, how to sell, but how of like where the area, the demand, be able to absorb this new supplies coming in.
Yes, and then last but not least is your unit type, layout, and size. Things you have to consider is, let's say, in a certain area, you're able to get a 2 beta versus going slightly further out, a 3 beta. Which one would make more sense in terms of investments?
Yeah, so this is all back to number and data to be able to assess what kind of units you can consider. And of course, if you're still uncertain of how do you select the right investment unit, you can reach out to us and get an investment consultant to contact you.
Yep. Okay, so the last part is on planning your exit. So I think when you enter, you always want to know, okay, when are you exiting? How long are you going to be holding this property for?
Yes.
And because we know about SSD just now, minimally you should at least look to hold this property for 4 years. And why it's important to understand how long you're holding for, because you also want to know like the buffer to set. In case anything happens, you don't want to be in a case where I got no rental, there's loss of income, I cannot pay my mortgage, I have to foreclose. I think that's the last thing that you want to be stuck in.
Yes.
So the next part we will talk about is the mode of holding, right? I mean, there are many ways of holding things. You can hold it in 99-1, you can hold it in 50-50. Basically means how many percentage of the share you're holding. It can even be like 70-30, but most often it's either people hold in 99-1 or 50-50.
Yes.
And why is mode of holding so important? Because it really depends on like what's your next step. Are you planning to like decouple? Eventually, I think for a family, there is always like the goals of having 2 properties. And if you do wish to hold your current property when you release the other person's name for the second property, then you may want to consider 99-1 rather than 50-50. Reason being because it will affect the cost of you trying to restructure this at a later stage. So for 99-1, it means that one person owns 99%, the other person holds 1%. 50-50 just means it's a fair holding. When you do the transfer for 99-1, the 99% will buy over the 1%. But of course, for 50-50, then you're buying over the 50%. So for transfer-wise, of course, when buyer A buys over the 1%, buyer B will just transfer this 1% holding to buyer A. And for 50-50, they'll transfer the 50% over. And what is the main difference in the 2 holdings is that for 99-1, all your costings in terms of buyer stamp duty or even SSD is paid on the 1%. So if you're talking about a $2.4 million property, 1% is $24,000. So if you do decide to decouple after 1 year, for example, you'll need to pay seller stamp duty on that 1%. And that is 16% of 24,000. That's going to be 3,840. But let's say you decide to hold this in 50-50, right? And 1 year later, your plans change. You decide to decouple. You have to pay 16% on 50% of the 2.4 million, which is 1.2 million. And that's going to be $192,000.
Wow.
So $3,840 and $192,000, the difference is huge. So plan properly, whether it's a 99-1 or a 50-50, because we've seen cases where people put in 50-50 and they decide and their plans change after that. Then they have to bear like a huge cost. That is one of the part, right? The second part is the buyer stamp duty. So even if you were to wait till your SSD period is up, regardless when you decide to sell it, there's always a buyer stamp duty that you have to pay. For 99-1, you pay it on the 1%. So that's about $240. But for a 50-50, even if you pass the SSD, you don't pay the $192,000. You will still be required to pay the buyer stamp duty on 1.2 million, which is 50% of the value, and that comes up to 32,600. So yes, it's not as crazy as 192,000, but 32,000 versus the $240, the difference is still quite significant.
Yeah, almost close to, I would say, 50 times higher.
Correct.
Yeah. And one last thing to take note is for decoupling, you can actually do an equity term loan if you ever want to. It'll probably appreciate in price. A lot of people may not know is that you can actually cash out a certain sum of money. Of course, there's a formula to calculate that. And if you're keen to find out more, you can actually approach our investment consultant, and I'm more than happy to belly out to you. Yeah.
So in this case, for 99-1 and 50-50, if you do decide to decouple after 1 year, the total cost difference between both would be $4,000 versus $224,600. So that's why when you buy into a property together with a partner, strategically think of what your next move would be before you decide on what your holding is.
Yes, indeed. So with this, we come to the end of this video. I hope that you've gotten the basics of how do we start investing in real estate. Okay, there are a lot of jargons, a lot of things that you need to take note. Okay, but the key thing over here is always choosing the right property.
I think there's a lot more to understand in how to pick the right property, but we try to make this as comprehensive as possible for someone who is completely new in looking for your next property.
Yes.
And you're here with, say, TDS or an MS or an LTV and you don't know exactly what it is. We hope this video at least gives you clarity on, some of the things that may help you get started. But if you still wish for someone to guide you through this whole process, so don't have to figure things out on yourself, you can always scan a QR code and we'll have someone reach out to you. With that, we'll see you in the next video. This is Grace.
This is Christian.
We'll see you next time.
Bye-bye.
Bye-bye.